Welcome to our Bid Ready series in partnership with ESD's GoSemi and the Division of Minority and Women Business Development Offices. We aim to produce the resources to get firms contract ready. Our agenda for today is as follows. Here we go. We'll give you a quick introduction of our Bid Ready series, some ESD resources available to you, and then our presentation by Surety Bond Associates, followed by any Q&A, and then finally, if time allows, we'll go over our ESD announcements, and then end the webinar. The Bid Ready series is aimed at supporting all small businesses, MWBs, STVOBs to become bid ready in New York State, especially as we enter this massive era of development. Just a couple notes as well. Our chat feature is off today. If you're having any issues or any questions, please message the moderator or an ESD facilitator. No AI tools will be permitted today, and they will be removed by us. By entering the room today, you are agreeing to be recorded, and you agree to be courteous to all individuals in this room. As a reminder, please be sure to change your display name to your first and last name, especially if you are entering using a phone. Please note the views presented in today's webinar are those of the speaker and do not necessarily represent the views of ESD or the New York State government. Bear with me as I get these slides working here. All right, just some of our resources that ESD has. We have our Capital Access Program, a lot of different features there to help you become bid ready, prepare and work on larger contracts. Of our EAC centers is an enterprise development program with centers throughout New York State to provide instruction, training, technical assistance, and support services to individuals who are interested in starting or recently started their own business or entrepreneurs seeking to expand or strengthen their early stage businesses. Of our SBDCs, our small business development centers, and these provide no-cost, confidential one-on-one business advisement, training, and research to small business owners and entrepreneurs throughout New York State. We also have our Manufacturing Extension Partnership. There's a network of organizations that provide growth and innovation services to small and mid-sized manufacturers in every corner of the state to help them create and retain jobs, increase profits, and save time and money. The Governor's Office of Semiconductor Expansion Management and Integration, or GoSemi, is part of the Bid Ready initiative. There is a lot of development in central New York, and there are many projects underway and upcoming. Stay tuned to the Bid Ready series for more information and events down the line. And just some additional ESD upcoming events. We have a few more Bid Ready live webinars scheduled. July 15th at 1 p.m. we have New York Creates, and on August 4th, 1 p.m. we have our continuing program with Surety Bond Associates. We'll be covering construction accounting and choosing the right CPA, and also the MWBE Expo at the Javits Center in New York City on July 23rd. That'll be a big one. Oh, sorry, on the slide there. And I'll now introduce Ellen from Surety Bond Associates, who will provide a presentation on their firm and how to be a successful bid partner with them. And Ellen, let me know if you can't share your screen for.
I think you have to stop so I can start.
You got it. All right.
Okay. Good afternoon, everyone. My name is Ellen Nalen, and I'm the owner of Surety Bond Associates. Switched over to full screen. About a year ago, we were hired by Empire State Development to provide technical assistance associated with their New York State Surety Bond Assistance Program. So we're going to talk a little bit about the assistance that is available later in the presentation. Um, but to get started, about $500 million dollars in federal funding is now available to support the resurgence of small businesses across New York State through the State Small Business Credit Initiative, or SSBCI, which is a program through the American Rescue Plan Act, and it's managed by the U.S. Department of Treasury and provides funding to support programs for small businesses including socially and economically disadvantaged individual or SETI owned businesses and very small businesses. And we'll get into what those definitions are a little bit later. And the program is really meant to help recover from the economic effects of COVID-19 and allow small businesses to succeed in this post-pandemic economy. And with this funding through Empire State Development, they've developed a suite of capital access and equity programs for New York State small businesses to help sustain them and help them recover and continue to succeed so that they can participate in some of these upcoming projects like SETI. Through our partnership with Empire State Development, Surety Bond Associates and our team is providing financial, accounting, legal, and technical assistance to help contractors successfully secure surety bonds so that you can bid and execute on these publicly funded projects that include contracts from cities, towns, villages, state and federal public authorities, and these larger projects like the GoSETI program. Eligible contractors are able to receive a guarantee of up to $600,000 that is actually meant to enhance your ability to secure bonding lines. So now I'd like to just talk about some of the barriers that emerging contractors face when they're trying to enter the public construction arena and any of the large construction projects. Breaking into underrepresented industries like construction is very difficult, especially for small, minority, women-owned, and veteran-owned small businesses. Most of these smaller contractors have limited back office support systems. Everybody is challenged these days with a lack of quality workforce, and it's even harder for smaller contractors to get and retain quality workforce. And then those that are seeking certification as an MWBE or a service disabled veteran-owned business have to go through that extra process. And then there's challenges with the whole bid processing system when performance issues arise on a project. Smaller firms, kind of get caught in a vicious cycle of not being able to respond. They get bogged down with paperwork, and it's just very difficult to navigate through that whole process. And then last but not least, access to financial resources like bonding and financing is another barrier that all small contractors face. So, in response to these barriers, a lot of contractors just avoid bidding on bonded work altogether. And that's, not necessarily the best strategy because most of the more lucrative contracts are going to be publicly funded or, quasi-public and private funding is in use. And chances are those lucrative projects are going to require bonding. A lot of contractors get caught, just bidding under the prime contractor's bond. They think they can't qualify for bonding. so they don't even attempt to, and that just holds contractors back. They're, contractors that aren't at a higher tier level in the process are going to wait longer to get paid. Then there are some agencies and GCs and construction managers that advocate for bond waivers or alternative insurance products. You may have heard of the term subguard insurance. That's subcontractor default insurance. And those types of coverages don't really protect any of the smaller subcontractors and vendors like bonding does against not being paid by the prime contractor. So that isn't really, an adequate response to the barrier. Or even worse off, smaller contractors bid with a certified check and then they haven't established a relationship with a bonding company yet. So if they are awarded a contract that requires performance and payment bonds, that certified check could be defaulted and used to award the project to the next lowest bidder. So you never want to bid with your own assets. You don't want to collateralize your bonds with your own assets. Your cash and your working capital really need to be preserved to perform the work on your contract. So now just before we get into the assistance through New York State, I want to make sure that everybody understands what contract surety bonds are. It's very important that all construction companies understand how contract surety bonds function, how surety companies pre-qualify contractors, and that's what we're going to focus on, in a few minutes. But most of you probably know that public work is usually awarded through a competitive sealed bid system. And surety bonds are the mechanism that makes this system work. And those projects are generally awarded to the lowest responsible and responsive bidder. So the bid bond is what makes that part work. The bid bond provides a guarantee that the contractor, if they're awarded a contract, they're going to be able to move forward and sign that contract and provide the required performance and payment bonds required by that contract. If you bid with a certified check, you could, as I mentioned before, default if you're not set up with a surety company to provide a performance bond, which guarantees that you're going to comply with all the terms and conditions of that contract that you bid on, that you're going to complete the project within the time frame allowed and for the price that you quoted. And the payment bond, this bond protects your suppliers and vendors and any subcontractors providing labor and material on the project. And for public projects in particular, this is often this is often the only payment protection that they have because you can't put a lien on a public building. And then sometimes there will be a maintenance bond required at the end of the project to guarantee whatever the warranty or the maintenance period is in the contract. Now, the bid and the maintenance bonds are usually only for a percentage of the contract price, usually around 10%. The performance and payment bonds are for 100% of the contract price. So it's important that we all understand who requires bonds. The federal government was the very first to require bonds back in 1935 when they found that a lot of the Capitol buildings that were under construction were left unfinished. Either the contractor went bankrupt during the job or just walked off the job. And for whatever reason, they were left with these unfinished projects, and that's when Congress passed a law requiring that the use of surety bonds be used on any federal construction contract. That law still exists today. It's called the Miller Act law now, and the federal government requires bonding on any contract over $150,000. State and local governments all also have uh, laws requiring bonding. Some of them follow the federal law. The state requirements are more tailored to the federal laws. But some of your local governments, your municipalities, they may require bonding on contracts of $25,000 or $50,000. The provisions are going to vary. New York City, on the other hand, waives bonding on contracts under $1 million. They're the only municipality I know of that waives bonding. Most government agencies require surety bonds on just about every construction project. Private owners also require bonding. They want the same assurance that the contractor is going to complete the job, that they've been vetted by a surety company. And we'll talk about what that vetting process looks like. And they want to make sure that if there are subcontractors and suppliers that are being utilized, that those vendors will be paid. And if a lien is filed, that the payment bond will release that lien. Lenders also require bonding to protect their construction lending capital. And general contractors are requiring bonds on a much more frequent basis than they used to mitigate against default due to subcontractor failure. And we've seen more subcontractor failure since the post-pandemic recovery. Now that some of the PPP money and the other government money has gone away, subcontractors are starting to suffer. So bonds are frequently confused with insurance, and it's not surprising because insurance companies are the entity that provides bonding. But the process of obtaining bonding is more like obtaining a bank line of credit than purchasing insurance. If you can afford insurance, and you accept the terms and conditions of that insurance, chances are you're going to qualify for it. Surety bonds, the contractor has to meet the pre-qualification criteria of the bonding company. And that process is very similar to applying for a bank line of credit. Banks only want to lend money to companies that they know that can pay them back. Surety companies only want to bond contractors that they believe can fulfill their obligations. And if there is a claim, whether they're defaulted by the owner under the performance bond or there's a payment bond claim submitted, and they have to pay out on the contractor's behalf, they want to make sure that the contractor has the wherewithal to pay them back. So that's how bonds are more like lending than insurance. With insurance, you might pay a deductible. If you have a loss, your insurance premium might go up. With a surety bond, if there's a loss, you're required to pay back the surety company. The other thing that's different between insurance and bonding is that there's three parties to a surety obligation. With an insurance policy, the policy is just between the insurance company and the policy holder. But here we have either the government agency who's requiring the bond, or the project owner who's requiring the bond, or maybe it's a subcontractor that needs to provide a bond to the GC. The surety is guaranteeing that the contractor is going to fulfill whatever that obligation is to the owner or the obligee. The surety, on the other hand, enters into what's called an indemnity agreement, and it's very similar to a loan agreement. It's a hold harmless agreement, and it spells out the nature of the relationship with the surety company and the obligations of the contractor to fulfill their obligation to the surety. And the main reason is to pay them back in the event there's a loss. Now, the company has to sign this indemnity agreement. Any owners of the company have to sign the indemnity agreement, and any spouses of the construction company have to sign the indemnity agreement. And this is very similar to a loan agreement. And the reason all of these signatures are required is the surety doesn't want the contractor to be tempted if there is a problem and divert assets out of the company who's primarily responsible for the obligation. The owners and spouses are secondarily responsible. The principal party is going to be the business itself. But this indemnity agreement prevents the temptation of moving assets out of the company into a spouse's bank account. So now we're going to talk a little bit about the pre-qualification process that the surety company undertakes. And this process provides an in-depth look at the contractor's entire business operation. And they're determining the contractor's ability to meet their current and future financial obligations and to perform the construction projects that they're engaging in and asking the surety to guarantee with their bond. The goal of the pre-qualification process is similar to the goal of the bank's evaluation process as well. The surety company wants to make sure that the contractor runs a well-managed and sound business, that they maintain fair business practices, and that they perform their obligations and their honor their commitments as agreed. So the surety company is looking at these basic three buckets when they're underwriting a contractor. They're looking at the contractor's capacity to perform. They're looking at their capital or their financial strength, and they're looking at their character. And we're going to break down each one of these three C's. For the capacity to perform, the contractor is going to be asked to complete a pretty extensive application, and that helps the surety company get an understanding of the track record and the history of the company. Sureties ask for trade references, and they perform those trade references. They look at the contractor's organizational structure and the reporting hierarchy. They're going to ask for resumes of all the owners of the construction business and any key personnel. They want to make sure that the company has good estimators and project management and superintendent teams in place. They look at tools and equipment, especially if the contractor is performing heavy highway construction or any specialty construction. They want to make sure that they have access to the tools and equipment to perform their work. They look at business and continuation plans. They want to make sure that there has been some thought given to, what happens if the owner of the construction business becomes incapacitated, or perhaps dies. They want to make sure that there's key man life insurance in place and a plan to keep the company going, to complete the projects that the surety company is guaranteeing with their bond. They focus a lot of their initial analysis on analyzing past and current projects. They want to make sure that the contractor isn't overextending them with their current backlog of work by entertaining larger projects, perhaps. They also want to make sure that past projects were successfully completed. And this goes into the referencing aspect of the evaluation project process. They will want to talk to project owners or engineers that are familiar with the contractor's work to make sure that the contractor performed the work successfully. They want to make sure that the project was profitable. They ask for insurance certificates, not only to confirm that the contractor has adequate insurance in place to be compliant with the contract obligation, but that they're adequately insuring their operations so that there isn't a financial impact of maybe a catastrophic event. They want to make sure that all the risks of the business are being insured properly. When contractors are first initiating a relationship with a surety company, their financial strength is probably emphasized the most. And that's because the surety is trying to evaluate their ability to not only manage their projects, but also potentially pay them back if there's a claim. So typically, surety companies want to see detailed financial statements, preferably prepared by a CPA that's familiar with construction. They like these financial statements for most construction companies to be prepared using percentage of completion accounting. And we'll get into what that all means in our upcoming construction accounting workshop. So you're not going to want to miss that. They prefer CPA review quality financial statements as well. And that doesn't necessarily mean that when contractors first start working with us, that they have all of these things in place. But this is just to give you an idea of what would be expected of you as you continue to grow your business. They look at contract schedules, they look at work in progress schedules and completed contract schedules. And these schedules have to also be included in your detailed financial statements, which are much different than a tax return. And again, you'll learn more about this in our next webinar. They look at a contractor's back office accounting system and your job cost accounting systems. They want to make sure that you do have a good accounting system in place. They look at profitability trends. They look at cash flow projections. They check credit references, not only of the business itself, but also of the owners of the business. Surety companies usually like to see that contractors have a bank line of credit. And especially, if they're performing work that is going to require them to wait to get paid. And on many of these public projects, especially if you're a subcontractor, you're going to be waiting to get paid, probably 60 to 90 days. So you have to be able to continue to meet your current obligations during that time, and a bank line of credit is very useful. They also will ask for personal financial statements, and if you own any other businesses, they'll want to see tax returns on those businesses, and more times than not, your additional businesses will also have to be included in that indemnity agreement. The next aspect of the underwriting process is the character, and this is the owner's reputation in dealing fairly with project owners, subcontractors, suppliers, and lenders. So this is where the surety performs their reference checks. They talk to bankers, they talk to project owners, they will talk to your vendors to make sure that they've had a good experience with you. So they'll want to know who your subcontractors are. and your suppliers. So now I'm going to talk about the Surety Bond Assistance Program and remembering all the barriers that we talked about in the beginning of this presentation. And now that you have more of an understanding of the whole process that goes into applying for surety bonds, that's why Empire State Development developed the New York State Surety Bond Assistance Program. And this program is really designed to eliminate the barriers for New York State socially and economically disadvantaged individual-owned businesses or SETI-owned businesses, and also for very small businesses. And the definition of a very small business is a business with fewer than 10 employees. The definition for SETI-owned businesses is any business that is owned and controlled by individuals whose access to credit has been diminished due to factors like racial or ethnic prejudice, gender, disability, or even rural residency. So for a business to be considered SETI-owned, and this does include minority and women-owned certified firms and certified service disabled-owned businesses, but you also don't have to be certified to qualify for the resources available through this program. So it really opens the door to just about every small business in New York State. So through our partnership with Empire State Development and our technical assistance program that we're providing workshop series. And the focus of the workshop series is to prepare contractors for surety bonding. To participate in these larger scale projects, even if you are not required to put up a bond. Every one of the contractors that you're going to be bidding to is going to want you to be pre-qualified for bonding. They're going to want to know that you have gone through that vetting process that we talked about. So it's really important that if you're planning to participate in these initiatives, that if you don't have bonding or you don't have sufficient bonding, that you really need to get qualified for bonding. You can include your bonding capacity in your capability statements on your website. Some of your vendor profiles may also include your bonding capacity. And this is really important as contractors and agencies are looking to do business with you. Like DASNY, for example, they have a very robust um, uh, small business initiative, and most of their contracts require bonding. So it's very, very important that contractors move forward and get prepared for surety bonding, and we can help through our workshop series. A lot of our emphasis is on construction accounting and back office. This is where contractors are weakest, usually, is with the back office. We also offer a full day QuickBooks for construction clinic that is taught by our construction CPA partner who will be joining us in our next webinar in the series. We also have a construction attorney and a construction insurance specialist that provide assistance with any construction legal challenges, dispute resolution issues, and financial and risk management. There is a link here to apply for the New York State Surety Bond Assistance Program. If you are interested in participating in it, I would highly recommend that you fill out our online application form. You're already eligible and able to participate in our workshop series with Empire State Development, and I encourage you to pursue that as well. To get access to our one-on-one technical assistance, you will have access to our surety bond advisors. You have access to our construction accounting specialists. We have a couple of those on our team and a back office support specialist, a construction attorney, and our construction insurance specialist. You have access to one-on-one technical assistance with all of these experts in addition to the workshops themselves. One of the initiatives through Empire State Development is the New York State Contract Financing Program. That is a loan program that is available to SETI and very small businesses. We do partner with one of the providers of this program who will be one of our speakers during our financial management workshop. And last but not least is the 30% surety bond guarantee that is available through Empire State Development. This provides an enhancement to the contractor's bonding program and helps really relax some of those requirements that we discussed earlier, having to provide CPA prepared financial statements, having to have access to capital, having to have access to all the resources that a normal surety underwriting process would include. So you have an enhancement from the state to help you overcome some of these barriers. Our surety bond advisory services through this program will guide you through the whole bond application process. You'll be working with my associate Jocelyn Thornton, who's in this webinar today. She'll help you gather all the supporting documents that are required of your bond application, and we will facilitate getting you access to the New York State Surety Bond Assistance Program guarantee and also help you develop strategies to either obtain or increase your current bonding capacity. So to be eligible for the Surety Bond Assistance Program, you really only have to be a New York State, SETI, or very small business to qualify. You have to be in business at least 2 years. The maximum bond line or single bond limit generally is 2 million, but sometimes there is flexibility with that size standard. We're usually looking at minimum gross revenues of 400,000, but there is flexibility there too, and maximum gross revenue not to exceed $5 million. There's also a minimum personal credit score with this program of 600. And you have to be able to demonstrate that you have experience performing similar work to the contract opportunity that you're currently pursuing. So that is our workshop for today. Thank you, everyone. And I think we might be opening it up for questions and answers.
Yes, great. Thank you. That was very informative. So we've got a couple Q&As that we'll start with. Again, if any of our attendees have questions, please utilize the Q&A function as the chat function has been disabled. So we'll go ahead and start with a couple ones in no particular order. We have a company who's expanding from telecommunications infrastructure into larger public works and general construction. And they ask, what advice would you give them to position their company for larger bonded projects over the next two to 3 years? And I know that one might be difficult because of it's very specific, but they also would like to know, what are some common mistakes they should avoid?
That's a very good question. A lot of contractors are not using a good construction CPA firm. I think that is critical as you start to grow your business and develop strategies to retain profit in your business so that you can build your balance sheet so that you can start going after some of the bigger projects. We're going to be talking in our next workshop about the importance of working capital. So preserving as much cash as you can in your business at the end of the year and reinvesting it back into your business and not be tempted to save money on taxes by pulling it all out at the end of the year, I would say that is probably the number one um, thing that you should focus on, and definitely get a relationship established with a surety bond agent that has access to construction CPA firms and construction lenders and can provide you with consulting and guidance through the whole process.
Great. And that's so that sort of answers another question we had in there. The person was asking, should they establish a relationship with a bonding company now, even if they don't need a bond immediately?
Definitely. You don't want to wait to apply for bonding when you need it because it's going to be harder to get. Just like with working capital, get it before you need it. You need to understand what your bonding capacity limits are before you start going after bonded projects. And to help avoid that situation we talked about earlier, where the job of your dreams comes out to bid, you don't have a relationship, you bid with a certified check, and then you can't get bonding.
Right.
Know your
Yeah, I
limits
know.
and know how to build your capacity.
Great. And so I know, we focus a lot on construction because obviously bonding is needed in public works construction projects. But we have a company who specializes in photography, videography, live streaming, AV
Mhm.
media production. Is that something that could typically have bonding requirements, and is it something they should get bonded for?
There are some service contractors that need bonding. I'm not sure that I've ever seen anything for video production, but it wouldn't surprise me. It's always good to get, it's free to get pre-qualified for bonding, first of all. There's no cost associated with it. So you may as well, take pursue the application. And then you can
Like you said,
promote
it's
yourself
better.
as being bondable.
Yeah. And if that contract does come up where it does require bonding, you've already
You're
got your
ready.
pre-qual, you've got your relationship, you're ready to jump in, which many of your competitors may not have done.
Yeah.
So it kind of gives you a step up.
And access to
Um,
bonding really is one of the primary ways to get bid ready.
yeah,
Yeah.
for sure. Here's another question we have in the chat. What can a small company with a gross of about 200,000 do to prepare for bonding?
There are some fast track programs, fast bond programs. I would recommend focusing on your personal credit score. For smaller contractors like that, you can get access to bonding pretty easily with just a one-page application if you have a credit score above 680. And then you can start building your capacity from there.
Gotcha. So you'd say it's kind of like lending, right? If your business is new, you don't have much business activity, that they're gonna rely on your personal
Yep,
credit score, personal finances a little more
yep,
for the underwriting on the bond. Okay,
exactly.
great. All right, so we'll give it a few more minutes, see if there's any additional questions. So just to recap on some of those Q&As, I think the big thing, like you said, was, make sure you've got, if you're in the construction side, a construction focused CPA to help you with your finances and your books. If you're not, obviously, you still want that. So you want a good CPA to help you with your business if you're in the service industry or anything like
Hmm.
that. And get that relationship with a bonding company started early. And obviously, SBA is a great starting point for any questions or needs that our vendors might have. So, all right. Well, if any other questions pop up, we'll go to those. I did post a couple links from SBA in the chat, and I'm just going to go over some of our last minute items. Make sure I got my Q&A still up in case there's any last minute additions. my screen share doesn't want to work today. Right, just in case you may have joined the presentation late, we do have some more ESD upcoming events. Basically, we have our next Bid Ready series scheduled. So on July 15th, that's at 1 p.m. That's with New York Creates. I know Rodney can correct me if I'm wrong, but that's a New York consortium of semiconductor manufacturers, tech hubs, work groups that are moving forward the semiconductor industry in New York State. On August 4th at 1 p.m., we have our Surety Bond Associates Part 2, Construction Accounting and Choosing the Right CPA. And just in case I forgot to mention, this is a 6-part series with SBA where we'll be going through a number of aspects of the bonding process. So make sure you stay tuned to the Bid Ready webinar series for that to see the next series coming out. And again, we have our New York City MWB Expo at the Javits Center on July 23rd. You can go to the ESD MWB webpage for more information on that. Again, just some of our services we offer, the ESD Division of Small Business and Technology Development Capital Access Program. I know we touched on this earlier, but again, loan loss portfolio insurance program designed to increase financing opportunities, matching funds for loan loss reserves as an incentive to increase small business lending. Our EAC centers, providing instruction, training, technical assistance, and support services to our early business or entrepreneurial business owners. And our SBDC centers, no-cost, confidential, one-on-one business advisement, training, and research. Finally, our manufacturing extension program focuses on small and mid-sized manufacturers, providing growth and innovation services, help create and retain jobs, increase profits, save time and money. GoSemi, again, our Governor's Office of Semiconductors, working to increase the semiconductor industry across the state. Again, keep an eye out on our Bid Ready webpage for future GoSemi events. And then stay in the loop. Obviously, we have pre-recorded webinars on our Bid Ready web series. A lot of good training topics in there as well as recordings of any of our previous live webinars we've done with either our prime vendors or our training partners such as SBA. So a great website to find some great information on. All right. Well, I don't see any more questions in the Q&A. Just want to thank everyone for taking the time to join with us. And again, stay tuned for SBA's next presentation, which will be on July 15th.